Dear esteemed clients, we are pleased to inform you that Fidelity Banks PLC issue of 127 billion combined offer of rights issue and public offer is now open and scheduled to close on Monday, 29th of July 2024. Please see below the summary of the indicative terms of the offer. This is the email I received from my broker, who is actually one of the issuing house of Fidelity Bank. Now, the big question right now is Fidelity Bank stock or public offer at 9.75, sorry, a buy or not? Knowing fully well that the stock is currently selling for 9.9, closed yesterday section at 9 naira 19 kobo, 90 kobo, haven't reached a high of 13 naira. So let me confirm this. A high of 14 naira. So 14 naira, 15 kobo compared to a public offer of 9.7. So the question is Fidelity Bank a buy? That is what I will attempt to answer in this question. If this is the first time you're watching this video, kindly hit the subscription button, turn on the notification bell, and also make sure you follow me for updates. So in this video, I want to quickly show you how to analyze banking stocks. And then we would most likely be using Fidelity Bank as a case study because of their recent public offer. So Fidelity Bank is one of the banks in Nigeria. I'm sure you're aware. I'm sure this logo is familiar. I don't think I want to talk about how the bank started or the bank CEO. She's done a wonderful job in moving the bank from where she picked up at a lower price to the current price, at least in the last 5 years. This bank has done over 500%, at least average of 100% per annum based on their growth rate. And this is quite impressive. But then we want to look at the price of Fidelity at 9.7. Is it a buy? Is it cheap? Is it expensive? Based on the bank's metrics, based on the bank fundamentals, do you think Fidelity is one bank that I want to buy right now? So I will attempt to answer that question while I discuss how to analyze and pick great banking stocks. So here's a disclaimer. Now, the ideas shared in this video are based on my personal research and calculations. Kindly do your due diligence before you invest in this company's stock. And also know that the stock market comes with a lot of risk due to uncertainty. So please make sure you vet my recommendation based on your risk profile. It's very important. So let's talk about what you've been learning. Now, when you're analyzing banking stocks, there are certain things you need to watch out for. Now, first one, you need to know the type of business your bank is doing, the type of business they run. Now, is it a loan? Is it an investment or hybrid bank? People just assume that, oh, this is a bank. They collect money and then they make money by giving out loan. They make money by doing this. So, and then without confirming where the bank is actually positioned, how the bank is actually driving revenue based on its business model. So you need to understand a bank's business model. So there are some banks that run a loan-driven business. That means when you look at their structure, when you look at certain numbers, you can easily tell how they make their money too. And then you can also, that will also help you understand the type of risk that the bank is exposed to. So for banks that are loan-driven banks, these are banks that makes most of their money from loan. So that means the majority of their earnings are coming from loan. Now, when you look at investment-driven banks, these are banks that makes most of their money from treasury bill, bond. And then when you look at an hybrid bank, these are banks that makes money from both end. Now, before CBN introduced the LDR policy, which is loan to deposit ratio, I think around 2019, a bank like Stanbic IBTC was tilted towards investment. So if you look at the bank's exposure, a larger portion of their assets was on treasury bill. So they were enjoying free money. Now, if you look at the amount they are giving out as loan, very small. Cash advance, loan and advance compared to investment in securities was actually small until CBN forced bank to increase their loan to deposit ratio to an average of I think 65% then, but I understand that it's been reduced. Now, there are also some some banks that are hybrid, they do both. But I think that after CBN introduced the LGI policy, most of the banks, all of the banks were forced to become a loan-driven bank, except Jais Bank because of Islamic policy. So These are the things we're going to look at. Now, you're also going to understand how the bank make money. How do they make their money? Now, even if it's a loan-driven bank, investment-driven bank, now you want to compare their earnings from core operation and non-core operation. That's very key. You want to be sure that the bank is actually making most of its money from its core operation while it's actually in business. So if it's making money from loan and investment, or if it's making money from non-interest activities, for instance, internet banking, maybe fees and commissions, bank transactions. So if a bank is making most of the money from fees and commission, that's a problem because hey, this is not why you're in business. So why are you making this amount of money? So it means you should most likely switch to a fintech bank. Or do you understand? So we'll talk about that. And then how is the bank funded? That is very important. How is the bank funded? Some banks are funded via customer deposits. Some are funded via debt. And I'll tell you why this is very important. There's an implication on each of these questions that I'm asking. Then is the bank really profitable? Is it really profitable? So we'll look at that too. And then we'll also look at efficiency ratio. This falls under profitability too. So it's part of the things I will look at when we talk about whether the bank is profitable or not. So let's go to the next slide. So we also discuss return on equity of that bank. How much is the bank making for every 1 naira of shareholders' equity that is being invested? Now, one thing I like very well is the customer confidence. You know, people don't know that there's a way you can track customer confidence in the bank because it's not enough for a bank to be making money on its own. And customers confident because if customers are not confident, there could be bank rush. And when it's a bank rush, that might even make the bank to collapse. Nothing can make a bank collapse faster than a bank rush. So we want to look at the customer confidence, very key. And then we'll then look at other things like CAGR ratio, compound average annual growth rate, bank, revenue, net income, earnings per share, what's our projected EPS for Fidelity Bank in 2024. And then based on that projection, what's our estimated fair value of Fidelity Bank. Now, based on the fair value, we then compare whether it's actually undervalued at 9.7 or overvalued at 9.7. So these are the things that we'll attempt to answer in this particular video. So it's a whole lot, and I think it's something you need to pay attention to because whatever you learn right here would also be applicable to other banks. So if other banks are going to be coming out with public offer with information you've gotten from here, even though I will try as much as possible to talk about other banks too, I also think that the knowledge you gain here would also help you to analyze that bank. So that way you will be able to pick the right bank for your portfolio or for investment. So let's start. Now, what is the business of your bank? What type of business is your bank running? You know, when you ask people that question, people always wonder, what do you mean? I thought it's a bank. So what kind of business is the bank running down, accepting deposit? And no, let's look at the business of a bank. Now, this is the question you need to answer. You need to find an answer to before you consider a share purchase. So if you want to buy a share in a bank, always know the type of business the bank is running. Now, it will help you know the type of risk. It will help you know the type of risk that a bank is exposed to and how they make most of their money. So there are three business models. There are banks that are tilted towards um, the loan business model. That means they make a lot of money from though they have mastered that loan business very well. There are also banks that make most of their money from investment securities. And then there are also others that probably combine both together. So how do you know whether a bank is loan-driven business or an investment-driven business? So there are things I watch out for. First one is you look at the loan to deposit ratio as well as the investment to deposit ratio. That's what I use to know. Now, what is the deposit here? Deposit here is the money they have collected from customers, the money you have in your bank. The question is, what is the bank doing with the money? It's simple. What is the bank doing with your money? So if the bank is putting a lot of your money in loan, then it's a loan-driven bank. And if the bank is putting most of your money in deposit, then it's an investment-driven bank. So let's look at Fidelity financial statement. Now, for the purpose of this video, I'll be using Fidelity's statement as at the end of last year, which is 2023. So let's look at Fidelity auditor reports as at December 2023. So what to look at the business of Fidelity? Is Fidelity a loan-driven bank or an investment-driven bank? So by looking at this number, we would attempt to answer that question. So I'm trying to get the statement of, okay, we're close. All right. So this is the uh, profit and loss of Fidelity Bank. So let's look at the balance sheet. Okay, all right, this is it here. So if you want to get this number, you look at the balance sheet of a bank. So this tells you virtually everything you need to know. Now, let's go back to our slide. We want to know whether Fidelity is a loan-driven bank or an investment-driven bank. So this is what you check. Now, what is the loan to deposit ratio of that bank? Now, Fidelity has, let's first establish deposit of Fidelity. That's customer deposits. So what's the customer deposit like? Now look at the bank statement here. This is as at 31st December. Now you see deposit from customer. Now deposit from customer moved from 2.5 billion, 2.5 billion in 2022 to 4 billion. 2.5 billion to 4 billion. So here, let's note this number, 4 billion. We're going to note this number right here. Now, what is the loan to deposit ratio? Loan to deposit ratio is to look at the loan in comparison with the deposit. So here, I want to pick the loan. So these are the loan. You can see loan and advance to customers right here. And then, yes, I think this is what we have. Some other bank, you will see loan to other banks. So loan here, you see 3. So this would be 3 billion divided by this number right here. So if I do this here, 3092 419 divided by 4014811. 30, yes, 77%. So loan to deposit ratio is 77%. You can see here 77%. And then investment to deposits. Now, what is investment security to deposits? We're looking at the amount the bank has invested in securities. You can see investment securities, financial asset at fair value, debt instruments, equity instruments. Yes. And then I think you can even look at the investment in subsidiaries right here. So, but here, this is what I'm interested in. From this figure down to that's 1, 2, and 3. 1, 2, and 3. So we're looking at 7. Let me quickly get my calculator. So because I want to follow what I'm doing, just to be sure that we're not forming any figure right here. So 7, 6, 8, 4 plus 227, 750 plus 41, 550. So that will give you 276. Can you see 276984? 276984. So 276984 divided by. So let's go back to our figure here. That's 4 billion and 4,014,811. 4,014,811. 4,014,811. What do we have? This is what? 6%. 6%. So this is clear that Fidelity is a loan-driven bank. This is the first thing you need to know. Loan-driven bank. So that means the bulk of Fidelity's revenue should be coming from their loan business. The bulk of Fidelity revenues should be coming from their loan business. So just 6% of the bank's deposits is actually invested in treasury bill, bonds, equity, but then 77% is invested in customer loan. So these banks already passed the loan to deposit ratio that CBN has set. So by understanding this, it means Fidelity is actually a loan-driven business, meaning that's why you see Fidelity always investing in SMEs. You see they have a lot of SME products, SME related activities. Why? Because they are focused on making money from loan. So it also tells you whether it's easy for you to get a loan from that bank or not. So that also gives you an idea that if you're looking for a bank that you can actually get loan from, then Fidelity might be one because that's actually their business. So Fidelity is also a bank that would be looking to sponsor activities that can drive their loan business. For instance, SME related programs. Any program that is able to bring SMEs together, then Fidelity is one bank that will most likely be part of it because that is exactly what they do. So if you're running a program, you have a show or you have an event that is targeted at bringing SMEs together, be rest assured that Fidelity is the bank that would most likely be interested in that. So although this is based on what I've just done so far, I'm not saying that's the best, but we have first established the fact that Fidelity is a loan-driven bank. Now, by knowing business of a bank, you can easily tell the type of risk they are exposed to, right? Now, it also means that the bank is exposed to credit risk. Do you understand? Interest rate risk. So, but then if the bank has a robust risk management policy, then I think that should also help them to cushion the effect because loan business is actually very profitable. Because if you look at the bank, how much banks are charging as loan, they are far more than what you would have earned if you invest in securities. Some banks are charging as high as 35 to 50% interest on their loan. But if they invest that money in CBN, they could be getting like 20%, 30%. So, which means if you can get your loan business right, you will make a lot of money in Nigeria. So that is one. Second part, how is the bank making money? That's also very important. Why I've been able to establish the fact that Fidelity Bank is a loan-driven bank. Now, how is the bank making its money? It's clear that the bank will be making its money from interest income. But then we want to check, is the bank making more money from interest income or non-interest income? Imagine a bank running a loan-driven business and they're making most of their money from non-interest income. That's a problem. That's a red sign because for you to tell me that you are efficient, you're running your bank very well, you have mastered the business of giving out loan, then I want to see the non-interest income far higher the interest income far higher than non-interest income because this interest income tells me how much you have generated from that loan business and also other related loan activities like investment. But ultimately, the money you generate from your interest income must be far higher than the non-interest income. If the non-interest income is higher, then that's a problem too, meaning that the bank is actually facing certain challenges in its loan business. So let's look at Fidelity non-interest income as at the end of last year. So we would look at the profit or loss accounts of the bank. Now, interest income on Fidelity, this is right here. The bank generated 434 plus 25, and then it paid out 182. So net interest income is 277 billion. Can you see here? 277 billion. Now, if you look at other non-interest income, which are fees and commission expenses, and then other operating income. So we're going to add these three together. These are the non-interest income. Any income that is outside the interest income is called a non-interest income. So Fidelity Bank interest income is already established at 277,366. So the non-interest income will be 49,600 plus 46,700. That will give us 96 minus this expenses here, 11,812. So this should give me 84,844. That's 84,488. So since they are all in million, that will most likely be 84.4 billion. So 84.4 billion compared to 277 billion. So here is 84.4 billion compared to 277 billion. So what does that tell me? It means that Fidelity Bank is actually making most money from interest income, which is expected. I don't want to see a bank making money from non-interest income. Most money from non-interest. If non-interest income is higher than interest income, don't even go close to the bank. It means something is happening in their business that in short, they should just wind down and turn to a fintech company. That's it. Now, like I said here, I like a bank that is making more money from its core operation because it signals efficiency and sustainability. But a switch to non-interest income is a sign that it's not able to monetize that is not able to monetize the essence of its existence, which is loan or investment. So in this case, Fidelity Bank essence of being in business is loan. So, and then it's also able to generate most money from its loan business. Now, you can even do a historical check, like in 2022, 152. And then if you look at this again, this if you add all this, it's not up to 152. 34.4 plus 7 is like almost 41 point something, 41 point something less 12. So it means the same thing also applies right here. So we went in 2022 and in 2023, the bank is still sustaining its loan business and also able to make more money from interest income. So that is a pass for me. And I like that fact that the Fidelity Bank is making most money from its loan business. Then how is the bank funded? This is very important. You know, when you run a bank, or if you look at a bank can either make money or generate money from two areas. First one is debt or customer deposits. Do you understand? They can make money from debt or customer deposits. Some banks can also get money from equity. Yes, equity can also come in. You have equity, you have debt, you have customer deposits. Now, we already know that banks pay higher interest on debt, which is commercial paper, private notes, debenture, or corporate bond. Some bank can say, oh, we need money, let's issue commercial paper. Now, the interest they pay on this particular debt instrument is actually higher than what they pay to account holders on their savings and deposit accounts. If bank is going to keep your money, how much are they going to pay you as interest? 2%, 3%. But if they had issued debts like commercial paper, they'll be paying as high as 20% right now if you look at the current interest rate environment. So what does it mean? It means that a bank that is largely funded by customer deposits will generate higher return on equity compared to banks that rely on debt. Very simple. Now, if most of the bank's money, they are coming in as customer deposits, you know the implication? It means that the bank is generating cheap money, cheap cash. Because the cash you're keeping in bank, how much is the bank paying you? If they had generated that cash via loan, they will pay more. So any bank that is able to pull a lot of funds and you know where the fund is going to loan. So how much is Fidelity Bank charging as loan averagely or banks? Right now, it's almost around 35 to 40%. Some are even as high as 50% per annum, depending on the risk. Now, how much are they going to pay the customer that deposited that money to the bank? Just less than 10%, 5%, to be fair. Let's do 4 to 5%. Now, look at the gap. Look at the gap. So, meaning that banks are tilting towards customer deposits. This is the reason bank will do anything. They will push their staff, they will give them targets to go and raise money out there. Because when they're able to raise a lot of money via deposits, it's like free money for them. It's because alternatively, if they had resorted to debt, they will pay more. Commercial paper right now is as high as 25 to 30%. Now, would a bank prefer commercial paper or customer deposits? Customer deposits. So they will do everything, invest in their mobile app, invest in ads, make sure that they are able to get you to pay or deposit with them. That's exactly what this means. So if I'm looking at it from the point of an investor, I like a bank that actually generates most of its funds via customer deposits because customer deposit is cheap. This is cheap cash. It is cheap money. So if a bank is generating most of its funds via customer deposits, I would prefer to buy shares in that bank compared to another bank that is relying on what? Debt. So it's important we look at that. So the question now is, how is Fidelity Bank funded? First one, we've been able to establish Fidelity Bank deposit, which is what? We will need this deposit as we go on. So Fidelity Bank deposit is around 4 billion. Can you see here? Fidelity Bank deposit is around 4 billion here. This Fidelity Bank deposit right here. Let me look at the balance sheet to verify this figure again. Fidelity Bank customer deposits. Customer deposits here is 4 trillion. Sorry, 4 trillion, not billion. It's 4 trillion. 4 trillion. Interesting. So Fidelity Bank deposit is 4 trillion right now. So it's not 4 billion, please. Now, what is the bank's borrowing? What's the bank's borrowing? So let's look at the bank's book. Fidelity Bank's borrowing. Look at the ability. You have deposits from customers derivative financial liabilities, current income tax, deferred tax liability, other liabilities, and provision. Debt issue. Now, this is it here. Debt issued and borrowed fund. Can you see 577 billion? 577 billion. So let's come back here. Borrowing is 577 billion. Fidelity Bank borrowing is 577 billion. Customer deposit is 4 trillion. 577 billion compared to 4 trillion. How is Fidelity Bank being funded? Customer deposits. And I told you before, customer deposit is cheap. Customer deposit is extremely cheap. Let's even see if we can drill down to what I call average cost of debt, because deposit and borrowing, they are both debts. Now, let's see if we can find this report. The interest the bank has paid customers on this fund and the interest the bank has paid its debtors on this particular fund. Let's see which of them is lower. So I will go back to Fidelity Bank financials. So what am I interested in? I am interested in the interest expenses. So both figures are lumped here. You can see interest and similar income, interest and similar expense. This is it right here. This is the interest, 182. So let's see if we can find a breakdown of this 182, because whether they collect, they mobilize fund from you, or they accept deposit, or they raise fund via debt, they will be exposed to this particular interest expenses. So we want to see a breakdown of this particular interest expenses in the bank's book. So this is note 7. I would come here. Let's look for note 7 on Fidelity Bank financials. This is note 8. Note 8, note 8, note 8, still on note 8. So let's see. Notes. I'm looking for note 7. I'm looking for note 7. Okay, note 9. Okay. So note 7 should be here. All right. Look, this is interest expenses, right? Now you see term deposits. This is the interest they paid. Now you can see the breakdown of 182 billion. So this is a breakdown. Now, term deposit, like fixed deposit, this is what they paid fixed deposit holders. This is what they paid for debt issued on borrowing. This is it here. This is what they paid on savings. This is what they paid on current accounts. This is what they paid on interbank takings. Now, look at this. We're going to add the deposit of a bank is made up of the fixed deposit, savings deposit, and current. That's like current account, savings account, and fixed deposit. So we want to add the 3 deposits to ascertain the total interest paid. So 107,610 plus 36, not 36, please, 21,799 plus 7,170. So we added this from fixed deposits. The third one is savings, 21,799, and then 7,170. So that gives us 136,570. So that's like 136 billion 570,000. So 136,570, 136,570, 136,570 divided by, what is the total deposits? 4 trillion. So since this is a million, we'll pick this 4,014,811. 4,014,811. So that gives us an average. Look at this here, 3.4%. So the cost of customer deposits is 3.4%. 3.4%. That means the average cost, interest of, we can call it cost of funds, the average interest cost that Fidelity Bank is incurring on its 4 trillion deposit from customer is just 3.4. Now let's look at the debts, which is 557 577 billion. So we're going back to the statements. So this is the debt issue. The interest on debt issue is 36,583. 36,583. 36,583 divided by, now what is the borrowing? 577,028. 577,028. That'll give us what? 6.3%. Can you see? 6.3%. 6.3%. Now, what exactly does this mean? This is very simple, and I'm getting this is very interesting. Now, Fidelity Bank was able to raise 4 trillion via customer deposits, and on this 4 trillion is paying just 3.4% as interest. Now, from its borrowing, it has 577 billion and it's paying 6.3%. That means the bank is paying less on its customer deposit. What does that mean? It means that if the bank wants to raise more funds, the bank will rather invest in things that would make customer to deposit with them. So sometimes you see the bank coming up with promo, save and win promo, save 10,000, win 1 million. We do that every month for the next 12 months, and people will be saving. People will be saving. This is exactly what this means. Because the bank from the book, they only have to pay 3.4% on this 4 trillion and 6.3%. So the cost of borrowing is a lot higher than the cost of the customer deposit, which is very perfect. Assuming cost of deposit is around 6.3 and cost of borrowing is 3.4, the bank would rather borrow. So the bank will most likely be pushing towards borrowing more. So a bank would be interested in things that saves cost for them. Now, imagine again, of this 4 trillion, imagine 77% of this 4 trillion. Let's go back to our initial calculation. Here, I'm trying to show you something that's looking interesting. Now, let's go back to the first slide where we talk about the business of the bank. Here, now look at this here. Of this 4 trillion, 77% of this money is actually given to customers as loan. And then on this particular loan, the bank is making an average of almost 30-something% as return. So I think there are a lot of things we're going to learn as we move on. So we can even look at the interest income on the investment securities and loan. That means interest-bearing asset. But then I want to take us gradually. You can always replay this video, but the idea is for you to understand the simple steps to analyze a bank. It takes longer time. But the truth is, if you find a good bank, stay with it. Stay with that bank. Because it's not easy analyzing the banking stock, just like I'm doing right here. So how is Fidelity Bank funded? Fidelity Bank is largely funded by what? Customer deposits. It's not funded by debt. And on this customer deposits, the bank is paying an average of 3.4%, which is a lot lower than the 6% cost of debt, which is the interest expenses compared to the bank's borrowing. That's fine. It is okay. Now, is Fidelity Bank really profitable? Is the bank really profitable? We need to know that. So how do you know whether a bank is profitable? This is what you do. Here, I look at two metrics, the cost of funds of that bank versus the net interest margin of the bank. Now, what is net interest margin of that bank? Now, this is what let's start with net interest. Now, on the bank's book, right here, let's go back to our initial P&L. Yes, on the bank's book, you note that they are a loan-driven bank, right? And as a loan-driven bank, you are focused on giving out loans to customers, either personal or corporate customers. Now, for giving them that loan, they pay you interest. So, which is what we call the interest income right here, which is what we call the interest income. Now, this interest income is not just your money. You're supposed to pay people that have given you the money. And who are these people? They customers. So that is where the interest expenses comes in, because they provided the fund, you give it out as loan. Now, what is your own share? Imagine the bank collecting our money, over 4 trillion, and it's able to generate 434 billion, and they are paying us just 182. Now, this is what the bank is keeping at its profit, 277 billion. 277 billion. Now, because there are some interests that are tagged credit loss expenses, because for giving out loan, don't expect all the money to be recovered. So the bank needs to provide for loans that will most likely go bad. Do you understand? So that is normal, and that's the risk. I told you the risk Fidelity Bank is exposed to, which is credit risk. So customers will default, and then they will lose the money. So, but then they need to also factor in the loss on that particular loan. So here we are deducting. That's what we call the credit loss of that particular bank. You can also drill this out down to note 8. We'll look at note 8 later. So to see a breakdown of this 67,436. Now, here's the point. The amount that the bank is finally earning from that loan business is what? 209. Can you see here? 209. So this 209 covers both the loan business and the investment business. But then the bank is tilted towards loan. That's one thing you must understand. Now, the bulk of this money is actually coming from loan. So what I do now is I want to see what is the net interest margin. The net interest margin is when you divide this number, which is the amount that eventually comes to the bank, the amount realized after deducting interest paid to customers and also after accounting for credit loss. This is what the bank is going to say, this is our own money. Now, from this particular return, we're not going to compare with the total amount that the bank has invested to generate this loan. Another amount the bank has invested to generate this loan is the amount that's invested as loan given to customers and how much it has invested in government securities. So if we go back to the bank balance sheets, so let's pick this figure, 209,929. So 209,929. Now, this is the total amount that the bank will say is our own. This is what we have realized. This is what we have gained after netting off interest paid to customers from deposits and also credit losses. Now, when we compare this to total amount invested to generate that money, just like return on investment. So net interest margin is like return on investment, for instance. Just give you an idea. So how much did the bank invest to generate that money? First one, the bank invested this money, which is loan, and then the bank also invested this amount of money, investment securities. You can see here, right here, right here, and then yes. So this particular one, we have 7 and 222. This one again is also equity right here. So we're going to add this to this to this and this. So that will give us, we call it interest-bearing assets. Interest-bearing assets. So the interest-bearing asset of Fidelity will be 3092,419 plus we'll add investment securities of 7648, 7684 plus we would add this again. This is coming from 227,750 investment in debt instruments 227,750. So we have equities at fair value through other comprehensive income for, so this is not an interest bearing asset. This is an interest bearing asset right here. So investment in subsidiaries, debt instruments at amortized costs. So 332,752. This particular debt instrument at amortized cost is also generates an income for the bank. So which is like 818,803. So 818,803. So we're looking at all the assets that generate interest income. So this generates interest income for the bank, debt instrument at amortized cost, investment in securities, fixed assets, financial assets, yes, it generates, and then debt instrument too, also, and then loan and advance. So everything gives us 1, 2, 3, 1, 1, 2, 3, 1, 4 billion, 4, 1, 2, 3, 4,146, 4,146,656. 4,146,000 divided by 4,146,656. So what have we done so far? Now, I am comparing the total amount the bank has earned from its loan and investment business, which is the net interest income, by the assets that have generated that money, which is an interest-bearing assets. So divided, that will give us 5%. Can you see here? That is 5%. 5%. So that means Fidelity Bank net interest margin is 5%. Can you see here? Now, what is the average cost of funds? What's the average cost of funds of the bank? Now, we've already calculated the cost of funds of Fidelity Bank right here, which is 3.4 and 6.3. So 3.4 plus 6.3, that will give us 9.7. 9.7 divided by 2 will give us 4.85. Can you see here? Will give us 4.85. So Fidelity Bank cost of fund is 4.85. 4.85. Now, the spread will be 0.15%. Now, what exactly does this mean? Now, the average cost of fund of Fidelity Bank, which is when you compare the interest it has paid out to customers, debt holders, and then divided by the total amount it has raised so far, the average is 4.85. Now, the net interest margin is what the bank is earning from, that means this money that it has borrowed is going to pay an average of 4.85 back, right? Now, if it now deploys this money, because the bank is borrowing, the customer deposit is accepting, it's using it to do something. One, is investing it in its loan business, is also investing it in government securities and also to subsidiaries, giving some as loan or debt to subsidiaries. Now, averagely, the bank is getting 5%. Now, when interest margin is more than cost of fund, we have a positive spread, and a positive spread is very, very okay. So let me tell you what it means. I borrowed money from a bank to do business, and the bank is saying that I'm going to pay back 30% on that money, right? That's my cost of fund. That's the expenses that I'm going to incur for borrowing that money, 30%. Now, so it would be wise for me to use that money to do a business that will generate more than 30%. So if the business I am doing is giving me 20%, 10%, am I not losing? I'm losing. So it means my net interest margin is like 10%, 20%, while my cost of fund is 30%. So it doesn't make sense. So I would rather borrow at a lower rate to make more money at a higher rate. If I'm making 100%, 200% from that money, and the bank is charging me 30%, I am better off. It means my cost of fund is 30%. My net interest margin on that money is what? Is 100%, 150%. So that's exactly what this means for Fidelity Bank. Fidelity Bank net interest margin is 5%, while its cost of fund is 4%. So it has a positive spread of 0. Which means Fidelity Bank is profitable. Is very profitable. Now, don't look at this 0.5% and say, is it not small? Banks are dealing with billions. Imagine trillions. If you do 0.5%, 0.15% of 4 trillion, do you know what it means? So I'm just looking at the percentage term to help you understand, make sense of the bank's financial statement so that you don't look at the numbers and are confused as to what to check. Or some of us will just rush down to profit after tax, profit before tax, and then eventually you see that the bank is having issues. Do you understand? So that is what, these are the things you need to check. So you're looking at the health. It's like carrying out health check on a bank. It's not as easy as you say it. These are the metrics. Are you willing to go through this process to find the best bank to buy in Nigeria? I am doing this because of this Fidelity Bank offer so that you can take right decision as per investing in the bank public offer or not. So here, Fidelity Bank is very, very profitable. Is Fidelity Bank efficient? Now, these metrics compare the non-operating expenses of the bank, like personnel costs, depreciation to the gross income. Whatever money the bank is generating, either from its loan business or its non-interest income. Now, when you compare the bank's operating expenses, because the bank has to pay salary, right? It has to pay for different expenses. So when you compare the bank's expenses with the total income, is it up to 40%? Is it more than 40%? I prefer a bank with its of efficiency ratio below 40%. That is where that means the bank is able to save costs. You know, when they say the bank is optimizing costs and the bank is highly efficient, this is what it means. It means the bank will generate more money without incurring much costs. Without incurring much cost, the bank is able to save costs. So a bank that is well optimized, that is optimizing its operation, this is how you know. So what do we do on Fidelity Bank statement? Very simple and straightforward. Let's look at Fidelity Bank to know whether it's able to optimize costs. So we're looking at the non-operating expense of the bank against the gross income of that bank. So what is the non-operating expenses of Fidelity Bank? Non-operating expenses of Fidelity Bank covers, this is it here, this is it, the personal expenses, the depreciation and amortization expenses, depreciation and amortization expenses, and other operating expenses. So we're going to add these three together to give us the total non-operating expenses. So 52,619 plus 7,042 plus 135,278. So that will give us 194,938. 194,938. So we'll do 194,938 divided by, look at the gross earnings of Fidelity Bank, 555,830. 555,830. So that will give us what? 35%, 0.35. 0.35. So Fidelity efficiency ratio is 0.35%, which is far below, which is below the 40% threshold. The bank that is reporting an operating efficiency ratio of 50%, 60% is a problem. It means majority of their income, they are going to what? Personal cost. You know, it doesn't, personal cost is not bad. It's not bad for a bank to increase cost, at least, or probably get things in order. But then a bank should be able to optimize cost, its cost. So if a bank efficiency ratio is above 50%, it means the bank is not efficient. By standard, a bank efficiency ratio should be below 40%. So that's one thing I like about GT Bank. There was a time GT Bank was the most efficient bank. You know, when you go online, you see headline, the most efficient bank in Nigeria is GT Bank. It's because of this efficiency ratio. That's why. So it's because the bank is able to earn more and then incur less. So Fidelity Bank has an efficiency ratio of 35%. That's also perfect. You can see across line item, numbers by numbers, by data, we are getting it. We are trying to get the best from the bank. Now, what is the bank return on equity? Now, this is best analyzed using the average historical record of the bank. So what you do is you look at average historical record of the bank by comparing its profits, net profits by shareholders' equity. So what are we going to do now? What is Fidelity Bank net profit in 2023? The net profit in 2023 is this is it here, profit for the year, 99,454 billion. 99,454. So net profit is 99,454. So I'll come here, I'll do 99,454 divided by, what is Fidelity Bank's, let's see, shareholders' equity as at December. Yes, total equity is 437,307. 437,307. 437,307. So that is what? 22%. I like net return on equity above 15%. That's the standard. So here, 22%, which is okay. So Fidelity Bank ROE, sorry, is 22%, which is fine. So, but then if you want to take a deeper look at Fidelity Bank's return on equity, you can do a historical check. Historical check means look at the average check in the last 5 years. Look at 2023, 2022, 2021, 2020, 2019, and then now compare the current one. If it's above the average, then it means that the bank is okay. That means for every 1 naira equity invested, the bank is generating 22 kobo as return. That's what the return on equity means. And this is very okay, 22%. Some banks have almost 30%, but I like the fact that it's above my threshold of 15%. Now, the next one, are customers' confidence in Fidelity improving or declining? This is very important. Now, if a bank like Fidelity is able to generate 4 trillion naira fund via customer deposits, and this is what the bank is using to drive its business, right? So the question is, that means we need to look at the trends of that customer deposit. So customer confidence in a bank says a lot about the bank's ability to sustain low-cost fund. Remember what I told you about a bank generating more of its funds via customer deposit. It means the bank will enjoy free cash. How much do they pay on deposit? Very small. Fidelity Bank average is like 3.4%. When you add fixed deposit, savings account, and also your current account, bank is paying 3.4%. So here we're looking at customers confident now. So a bank that raises more funds via customer deposits will generate more return than a bank that uses debt. I've already explained that. The bank's debt, cost of debt is 6.4. Customer deposits is around 3 point something. So what I do is I look at the average growth of the bank's deposit in the last 3 to 5 years. So if customers' confidence in the bank is increasing, then deposits should also reflect it. So the easiest way to check customers' confidence in the bank is to look at deposit growth. So don't just look at other metrics and ignore customer deposit. Customer deposit is very key. If customers like a bank and they are trooping into deposit funds, the bank is getting more funds to invest in its loan business, and that automatically means more return. So the growth in a bank's customer deposit plays a larger role in telling you what the bank's profitability position will look like in months or years to come. So let's look at the flow of customer deposits in the bank. Now, from our financial statements here, we could see that Fidelity Bank customer deposits increased from 2.5 to 4 trillion. From 2.5 to 4 trillion, that means the bank added 1.5 trillion between 2022 and 2023. So 1.5 divided by 2.5 is what? 60%. Now, I want to do a historical check on the bank's customer deposits. So let me quickly look at Capital Cube to run that check. So this is liability here. Let's see if we can find customer deposits here. Fidelity Bank customer deposits. Do we have it here? Yes. Now, look at customer deposit of Fidelity Bank. Very interesting. Now, this is 2023 financials. From 2.6 to 4 trillion. Trailing 12 months is already 4.7 trillion. And now, if Fidelity Bank's fund is largely generated from customer deposits, and customer deposit is growing, right? Customer deposit is growing. What does that mean? 77% of these customer deposits are being invested in loan. That automatically translates to increase in interest income. And because the bank is paying just 3.4% of it, it means the bank will most likely generate more return. So what? Net interest income. Just see the flow. Now, look at Fidelity Bank customer deposit from 2019. So let's look at the trend. From 1.2 to 1.7 to 2 trillion, 2.6, 4 trillion, and 4.7. Fidelity Bank's strength is in its customer deposits. That's a secret I just opened up to you right now. So as the bank continues to mobilize more funds from customers, there's no doubt that Fidelity Bank will continue to report higher net interest income. Why? Because the bulk of this money is actually being invested in loan. So that automatically means Fidelity Bank is one of the banks that have gotten it right in its loan business. And you can easily predict Fidelity Bank loan trend while also predicting its income trend. So if customer deposit increases and 77% of this money is being given out to customers as loan and advances, then, or sorry, banks or other businesses like SMEs as loan and advances, then we should expect higher return on its what? Net interest income. So what is the average? So this is year 1, year 2, year 3, year 4. I don't want to add this year 5 because this might likely increase. This is just as at first quarter 2024. So at the end of 2024, this might probably top 5, an average of 5 trillion. So let's put our expectation of Fidelity Bank deposit to hit 5 trillion, which is the highest. This is the highest so far in 5 years. This is the highest in a long time. So that means each year the bank is hitting new high on its customer deposit. So if I put a cap of 5 trillion on Fidelity Bank in 2024, so we want to calculate the average growth 1, 2, 3, 4, 5. So we'll do 5 trillion minus 1.2 in 2019. That will give me 3.8. So 3.8 divided by 1.2, that will give me 292. So 292 divided by 5. It means Fidelity Bank is growing its customer deposit by 58.4% every year. So Fidelity Bank is growing its customer deposits by 58.4%. So Fidelity Bank's customer deposit has been growing by an average of 58.4% in the last 5 years. In the last 5 years, this is very interesting. That means customers' confidence in Fidelity Bank is very, very high. Based on what I showed you, you can see that each year the bank is hitting new high every year from 4 trillion now already at 4.7. Most likely the bank will hit 4.5 trillion. Now, if we go back to what I shared earlier on from the beginning, one, how does Fidelity Bank make, what type of business is Fidelity Bank running? We're able to establish the fact that Fidelity is a loan-driven bank, right? Now, how does the bank generate its fund? How does the bank generate its fund? The bank generates most of its funds from what? From customer borrowing. You can see customer deposits of 4 trillion compared to 577 billion. Now, and then the cost of this deposit is just 3.4, while the cost on borrowing is 6.3, right? Now, its net interest income here is made up of what? More of that interest on loan and advances. So if you look at how the bank is making money, it's making most of the money from interest income. And interest income from loan and advances, they are far more than its debt. So I'm trying to connect something now. So if by looking at the customer confidence in Fidelity Bank, we were able to establish the fact that Fidelity Bank has an average growth in deposits of 58.4% average, then it means that it will most likely hit 5 trillion in 2024. Now, if it hit 5 trillion in 2024, it means that the bank will most likely make more money from interest income. So that automatically means expect Fidelity Bank interest income to surge higher in 2024, following massive increase in customer deposits. I like a bank that is enjoying customer confidence. Fidelity Bank's strength is in customer confidence. So you need to know where a bank is drawing its strength from. If this bank is enjoying massive deposits year on year from 2019 back to back in the last 5 years into 2024, and it's still continuing on the trailing 12 months, and this is a major driver of the bank income, then it means Fidelity Bank is worth watching. So look at the key metrics from top to bottom. We have been able to establish how strong, how efficient, and how cheap the bank is raising money from. Let's look at the compound average annual growth rates of Fidelity Bank. So let's look at the average annual growth rate in revenue, profit, EPS. From there, I will now project what Fidelity Bank EPS will be in 2024. And if the bank is able to deliver minimum EPS of that range, we'll then look at what the bank's share price should be. If the bank's share price is higher than what it's currently selling, then you can tell confidently that this is a bank you should mop up at 9.75. So let's do our calculation. Revenue of Fidelity Bank in the last 5 years. So let's go to total revenue under the income statement of the bank. I want to look at the average growth of the bank revenue. So here I will look at, I like to look at the net interest income because that's the core part of the bank's operation. The interest income is very key. Or you could look at net interest income after provision. This actually represents more than this because after this, it's going to pay interest expenses, going to pay for loan loss provision. You can see loan loss provision. So at the end of the day, this is what is left. So let's look at this right here. So I'll do 279, 297, 297, 828 minus 2019, 88,639. 88,639. That'll give me 209,189. 209,189 divided by 88,639. That's 236. 236 divided by 5. So that's like 47%, 47.2%. So 47.2% average revenue growth. Let's look at net profit and EPS of Fidelity Bank. So what's the net profit of Fidelity Bank in the last 5 years? Net income. So here, 130.28. So 130,894 minus 28,425. So that's like 102, 102,469. 102,469. 102,469 divided by this here, that's 360. 360 divided by 5. That's what, 72%. 72%. And then EPS, the bank's earnings per share here in the last 5 years, 4.1 trillion 12 months. So let's say 4.1 minus 1. That'll give us 4.1 minus 1. That'll give us 3.1. 3.1 divided by 1. Here, that's 310%. 310 divided by 5, 62%. Now, what does that mean? It means Fidelity Bank has been growing its revenue by 47% in the last 5 years, 72% in the last 5 years. This is the compound average annual growth. Compound average annual growth. Then earnings per share is 62% in the last 5 years. So if I'm to project Fidelity Bank EPS for 2024, then that would be the EPS of 2023 is 3.1. So 3.1 times what is the projected average annual growth rate? It is 62%. 62%. So 3.1, 1.62, meaning that if Fidelity Bank is able to grow its earnings per share by 52% minimum based on the compound average annual growth, I'm expecting Fidelity to report not less than 5 naira in 2024. So my projected EPS for Fidelity is 5 naira in 2024. 5 naira in 2024. That's my projection. Already, trailing 12 months based on first quarter is already at 4.1. So I'm projecting minimum of 5 naira in 2021. Now, using a risk-adjusted model, I have a video course on how to value a company, how to value Nigerian stocks. You can go to Coach Oge platform to watch that. I'll drop a link in this video where you can watch that. So if I adjust Fidelity Bank by 34%, so to be 5 divided by 0.34, it means that my fair value estimate on Fidelity Bank is 14 naira, 70 kobo. 14 naira 70 kobo. So you can see here, based on my projected growth rates of 62% on EPS, I'm expecting Fidelity Bank to report not less than 5 naira per share. Now, based on that 5 naira, Fidelity Bank share price might likely hit 14 naira 70 kobo. Now, when you compare 14.7 minus 9.75, that's like 4.95. 4.95 divided by 9.75. That means Fidelity Bank is 50%. So 4.95 divided by, 50% undervalued. So Fidelity Bank is 50% undervalued based on my calculation. So if Fidelity Bank is to trade close to 14 naira fair value estimates, then the price of the stock may likely touch 14.7 if it's able to deliver 5 naira, which is 50% undervalued compared to the current offer of 9 naira 70 kobo. So the question is, should I buy Fidelity Bank at 9 naira 75 kobo on public offer? My answer is capital yes. So Fidelity Bank is a buy right now. So if you have an opportunity to jump on Fidelity Bank at 9 naira 75 kobo, buy the bank stock. Because from the growth metric I've shared with you from beginning to the end, this bank is 50% undervalued based on my fair value estimate of 14 naira 70 kobo. So you can see how I'm able to analyze Fidelity Bank stock from beginning to the end. This is how I analyze banking stocks. If you do this for other banks, you can tell whether the bank is one you should buy into or not. I hope this video has been very enlightening, useful, and eye-opening for you that are asking whether Fidelity Bank is a buy. From what I've shared right now, Fidelity Bank is a buy at 9.70 kobo because my fair value estimate on this bank is 14 naira 7 kobo. No, this is a fair value estimate. It could be more or it could be less. But based on the metrics I've shared so far, from how the banks make money, how to generate money, how they're being funded, importantly, customer deposit, confidence in customer, confidence in the bank, how the bank has been growing customer deposit by 58.4% in the last 5 years. In short, this is one convincing reason why Fidelity is a buy at 9 naira 70 kobo. If you like this video, kindly hit the subscription button, turn on the notification bell. And if you want to join my community, kindly feel free to join my community via glofolio.com. This is our website where I manage community, and then from here you'll be able to join us. You see this is our subscription package. If you want access to Nigerian stock, want access to US stock, you want hybrid, you can quickly jump to this platform. Now, please, whenever you join our community, make sure you send an email to us. Make sure you send an email to us so we can add you to our WhatsApp group. We have a WhatsApp group, although we also have a mobile app where I share updates. But please make sure you are part of the community. It's very, very important. So I hope this video has opened your eyes and has answered your question on whether Fidelity Bank stock is a buy or not. Thank you.